everyone. As was mentioned earlier, this is a work with Andrila Chatterjee, who is a research associate at IGPC, and Professor Gopalakrishnan, who is my colleague in the finance and accounting area at IIMA Ahmedabad. So we consider the role of gold in household portfolios, household saving portfolios, particularly during the COVID pandemic. And So in this paper, what we do is we examine how households in India allocate their portfolio across three main categories of assets. One is gold, financial assets, and cash during the COVID crisis. And what we do is we consider differences in household portfolio allocation based on heterogeneity in COVID cases across the different districts in India. So COVID did not uniformly affect all districts. So we use this variation across across districts in the intensity of the COVID pandemic. So we use two main indicators. The main indicator we use is the number of COVID cases per capita, and the other indicator we use is a proxy for the economic impact in terms of satellite-based night lights. So there is variation in terms of satellite-based night lights, and satellite-based night lights is considered as a proxy for economic activity. So, we also examine the portfolio allocation based on the level of financial access, the variation in financial access across districts, the type of health infrastructure that is there in the district, and also in terms of prior gold holdings in that particular district. So we use this nationally representative household survey that Dr. Rajesh Shukla talked about in the morning. So this was conducted by IGPC and Price during the 2021 financial year. So this was during the onset of the COVID crisis. And along with that, we also use a prior survey to construct a panel. So we have a survey from 2015-16, and with the help of Price, we have actually constructed a panel to look at the differences between a normal period during the pre-COVID period and the post-COVID period. And so the main finding of the paper is that the portfolio allocation of households in the COVID vulnerable districts. So these are the top third of districts, which account for about 60% of COVID cases in India. So that the portfolio allocation shifted towards gold, and it shifted away from financial assets and other assets, primarily from cash, but more strongly from financial assets towards gold. So there was a portfolio reallocation. And we also see that when we don't consider just the COVID cases, but when we look at the economic differences in the economic impact across different districts, we see a similar kind of portfolio reallocation happening. And also, what we find is, this is something very interesting, that in districts that have better banking access, so the banking access is measured in terms of the bank accounts per capita. In districts that have better banking access, there is a smaller shift towards gold, because households probably have access to other kinds of financial instruments. And also, the other interesting finding is that in districts that have better health infrastructure, more hospital beds per capita, in those districts, we see a smaller shift towards gold. So that suggests that the shift towards gold is primarily in terms of sort of risk mitigation, is a risk mitigation strategy by the household. So if you have a better health infrastructure, if you have better financial access, then you see a smaller shift So this study contributes to a better understanding of the effect of the pandemic on households' portfolio allocation at the micro level. So we used household level data along with district level variation among all the districts in India. So just to give a brief background, there are a couple of other prior studies that have considered how household portfolios respond to shocks. So Bettermeyer actually finds that if you have higher wage volatility in Sweden, that is correlated with lower exposure of households to risky assets. So higher volatility means in wages is actually associated with less risky assets and a move towards safer assets. And Knupper studies the Finnish depression in 91-93, and they also find something similar, that households that were more affected by the depression, they were actually less likely to invest in risky assets and more likely to invest in safe assets. And in Norwegian households also, as the perceived likelihood of job loss increases, and this is typically during a crisis where the likelihood of job loss increases, Norwegian households shift towards safer assets. So all these studies suggest that there is there is a shift of households towards safer assets, typically during times of volatility and times of crisis. And a study of Italian households shows something similar, and there is also a study for US households that also shows something similar. So there is one study in India by Mushir and Suryavanshi. So they actually look at portfolio allocation, but they don't actually look at the actual allocation, but perception of allocation. So they do this small-scale survey of 184 residents in Delhi and Mumbai, and they ask the households that if when you have this COVID crisis, because of this COVID crisis, where are you likely to allocate your assets? So the difference between our study is that it's a much larger survey, it's a national survey, and we look at the actual allocation versus the perceived allocation. So there is some literature at the macro level. Darkbar and McDermott have found that gold acts as a safe haven. So that is something which has been there in the literature. Even for China, there's a study that finds that gold acted as a very strong safe haven during stock market crashes in China. There is other studies that find that gold actually initially served as a safe haven asset. So the concept of a safe haven is that the asset is uncorrelated with other kinds of financial assets. So during a crisis, when other prices of other assets go down, gold tends to hold its value. Now, what this study also finds that gold served as a flight to safety asset. So this is a new terminology in the literature. The flight to safety asset means that the households, so it's not just a price effect, but households are actually changing the quantitative allocation towards gold. Andrea will describe the survey, and I'll come back to the econometric methodology and findings.
So as Professor mentioned, our study mainly relies on the Nationally Representative Household Survey of Gold Consumption. This survey was conducted by India Gold Policy Center and People Research on India Consumer Economy across the year 2020 to 2021. So it covers about 40,427 households across 160 districts and 23 states in India. But based on the data availability of other variables that we have used in our analysis, we have restricted our sample to 21,600 households in 140 districts in 23 states in our study sample. For the DID analysis that we have performed later using a two-period panel data, we have used a common set of 4,629 households across 119 districts in 19 states between the 2020-21 survey and the 2015-16 survey. So we would like to thank Dr. Rajesh Shukla for providing us with both the surveys. The household portfolio is divided into three main asset categories. The major portion is comprised of the financial assets, which is about 66%, and it includes like investment made in stock market, bond market, PPF, chit funds, and also like bank deposits in bank account, post offices, and others. The second asset category is gold, and by gold I mean both physical and virtual forms of gold, which accounts for about 11% of the portfolio. The third category includes other assets, which include cash holdings at home, real estate, and we have investment in other precious forms of metals and stone except gold. So this is the summary statistics table of the variables we will be using in the analysis. The first four are the dependent and the independent variables, which Professor will discuss in the later slide, following which we have a set of household controls. We have log of household income, the number of female members in the household size, a dummy indicator indicating whether the household belongs to a rural area or an urban area. We have age of the household head, gender of the household head, dummy indicators indicating whether the household head is married or whether he is college educated. We also have a set of district controls. Log of district GVA per capita and district GVA growth indicates the economic prosperity and level of development of the district, following which we have the share of three main sectors in the GVA, which are namely agriculture, manufacturing, and services share. So the rest of the shares in the GVA include mainly fishing, mining, forestry, and construction. So I will now ask Professor Sanket to present the baseline results.
Thank you, Andrea. So on the screen, you can see the main econometric specification. So on the left-hand side, the dependent variable is the share of each asset. So these are three different regressions. One is for gold, the other is for financial assets, and the third is for other assets, which is mainly cash and real estate. And on the right-hand side, you have the CVD dummy. The CVD is the indicator for COVID vulnerable district. So these, as I mentioned earlier, these are the districts which were the hardest hit by COVID. So these are the top third of districts, but these districts account for about 60% of COVID cases in India. And then you have these household level controls and the district level controls. And we use this heteroscedasticity consistent standard errors, which are clustered at the block level. So this takes care of some of the issues in terms of the econometric specification. So this is the baseline result. So the font is very small. So what I'll do is I'll zoom in and focus on the main result. So what we find is that if you look at the first column, the gold share, if you look at the CVD districts versus the other districts, so this is the indicator for the COVID vulnerable districts, the gold share goes up by 6.4 percentage points. So if you think of the average gold share being about 10.7%, then a 6.7 percentage point increase is massive. It's about a 60% increase in the share of gold during this period for the COVID affected districts. And what you see is that is, so the share of financial assets is decreasing by 4.3%, and the share of other assets is also decreasing, but that's not statistically significant. And these specifications have the household controls, district controls, and all the different controls that Andrela mentioned earlier. Now, what we do is, one of the problems with a cross-sectional regression is that it doesn't account for heterogeneity across households, unobserved heterogeneity across households. So it's possible that there are some features of households that make them different from other households. So for that, you have to do a panel data analysis. And the panel analysis actually helps you in terms of controlling for household fixed effects. So household characteristics that are time invariant, but that are unique to the household. So what we do is we do what is called as a difference in difference analysis. I'll show that graphically how we do it, and then I'll go to the formal specification. So this is, so on the left-hand side, you have the asset share, which is gold, financial assets, and other assets. On the right-hand side, you have a dummy for the COVID period, and you have an interaction between the COVID dummy and the COVID vulnerable districts. So this coefficient beta 1 is capturing the additional effect of COVID for the COVID vulnerable districts. I'll show this graphically, which will make this a little clearer. So what we do is we look at, so what might happen is that during the COVID period, that there might be already some underlying differences between the COVID vulnerable districts and the other districts. So using the earlier survey, the 2015-16 survey, we look at the CVD districts and the non-CVD districts. And we see that there is a small difference. So there is a difference of about 0.5 percentage points on average. So CVD districts do have slightly higher gold holdings. But what you see during the COVID period is that gold holding goes up across the two categories. But you see a much bigger increase in the CVD districts. So what we are interested in is that compared to the pre-COVID period, what is the additional, how much is the wedge increasing during the COVID period between the CVD and the non-CVD districts? So, but this graph actually doesn't account for all the differences across households and differences across districts. So what we do is we do a formal analysis where we have household controls, where we have district controls, and importantly, we have household fixed effects. So this household fixed effect is absorbing all the differences across households in the entire sample. And then we have state fixed effects as well. The sample size comes down because there is when we look at the two surveys, we find that there are a much fewer number of households that are common across these two surveys. And what we find is very interesting. So after controlling for all these characteristics, during the COVID period, the gold share actually goes up by 7.3 percentage points, which is higher than what we found. But in the CVD districts, the increase is about 4.3 percentage points higher. So you find that the gap between the non-CVD and the CVD districts, the COVID vulnerable districts and the non-COVID vulnerable districts, that gap actually widens very substantially by 4.3 percentage points. So that is one of the key findings here, that even after you control for household fixed effects, the heterogeneity across different households, you still find that COVID had a substantial impact in terms of the reallocation of gold. reallocation of the household portfolios towards gold. And that is coming mainly from the financial assets, and that is, so the DID result is much more robust compared to the cross-sectional result. Because in a cross-sectional result, you can establish correlations, but you cannot really establish causation. So the panel data analysis actually helps you in terms of establishing a causation. So we can say that COVID actually affected the gold allocation using this panel data analysis. So Andrela will then talk a little bit about the heterogeneity across different districts in terms of financial access, health infrastructure, and prior gold holdings.
So we find that better access to health infrastructure leads to lower reallocation in gold in COVID-19 vulnerable districts. This can be captured by the interaction between the CVD and the total number of hospital beds per 1,000 population in the districts. It can be attributed to the fact that COVID-19 was essentially a health crisis, and access to superior health infrastructure actually reduced the intensity of flight to a safe asset like gold. Next, we see districts having prior low gold holdings show a more pronounced portfolio allocation to gold. This has been captured by the interaction between the CVD and low gold variable. Low gold is actually a dummy variable which takes the value 1 for districts having below average gold holdings as per the 2015-16 survey. We also see that districts having better financial access show a lesser shift towards gold. This can be attributed to the fact that if there is availability of better savings or credit products, the reliance towards gold actually decreases. So we have also done the estimation not just based on shares of asset as a dependent variable, but also amounts. And we can see in this case also the shift towards gold is in the same direction and is statistically significant. For robustness test, we have used two alternative vulnerability indicators. The first one, instead of a discrete variable like the CVD, we have used a continuous variable like district level cases per 1,000 population, and we can see that the shift to gold occurs in the same direction. The next vulnerability indicator is the nighttime light intensity. So prior literature in world development studies by Robert Baer and others have used nighttime lights as a proxy for economic activity. In this case, we see that for the bottom tertile districts recording the lowest nighttime lights, and that means the districts which have been most adversely affected by COVID show a shift towards gold. Finally, we have used an alternative threshold for COVID vulnerability. Instead of the top 33.3%, we have looked at the top 25% of districts recording the highest number of COVID cases. In that case, also see that the gold share has increased by 5.8 percentage points. Finally, to wrap up this study, we can safely say that our study supports the argument that flight to safety towards gold occurred in the COVID vulnerable Indian districts, and the shift occurred both in relative and in absolute terms, and the reallocation was primarily from financial assets and not from other assets, which includes illiquid assets like real estate. Our DID panel estimations support our main findings, and finally, reallocation differed across districts in terms of health infrastructure, financial access, and prior gold holdings. So if there are any questions.
I've just got one question on this.
Yes.
During COVID, even if the shops were all closed, so how did we come to the conclusion they were increasing load? That's number one. Second, Professor, during COVID, yes, a flight to safety is very clear from what you have presented. Are we intending to go back to them now and see whether they have shed that extra gold? It will be very interesting to see that piece now. It will be almost like a sequel, because flight to safety, now they are feeling safe, they have been vaccinated. Are they doing anything to that extra gold which they bought? Are you intending to do that study?
So thank you for the questions. Both of them are quite relevant. The period that we are looking at is the entire financial year. So the lockdowns happened for the first 2-3 months of the financial year. So we are looking at the entire financial year, and all the variables are sort of averages for the financial year. So they're capturing the average effect during the financial year. On your other suggestion, actually we were thinking about looking at how that reallocation, how that portfolio allocation changed in the post-COVID period. For that, we'll have to wait for the next survey, which is being conducted. We're planning to do that so that the survey would be available in the next few months. So we'll see how the situation normalizes in the post-COVID period.
The next wave that Rajesh was talking about in the morning that we are going to be doing, where we will again have some approximately 40,000 households. So same panel essentially. From that panel, there will be either the same or equivalent households from which they can collect. We will be collecting information about what they have done with the gold. So yes, the possibility exists for them to.
In the next year, probably we'll get an answer to what we will do when the risk passes away in them.
Yes, 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 yes.
Yes, I mean, completely agree with that.
So we know what Sanket and Andrila you have to do. So now
yes.
we look forward to this presentation from you next year.
Yeah, and that will be, the question is also very interesting in terms of when you go from a major crisis to a normal period, how does, do the effect of the crisis persist? Or so is there a structural change in terms of the behavior, or does it come back to the pre-crisis kind of behavior?
What happens after that you have acquired the safety? Are you going to give it back or are you going to stick where you were? Ramesh is interested.
Thanks.
Just note it down.
We already feel the rural area, the people are stick because I told before COVID our average bill ticket is 8 grams. Now you told 10 to 60% up. Our bill is 8 to 13 grams.
Okay, so similar kind of ballpark increase. So that is good to hear that.
And also now also it is continue, and the number of footfall is also.
That is also very interesting to hear because the next survey might actually answer that question, that whether this is a persistent kind of change or is it going to.
You please come to our rural shops. Take 1 or 2 shops and sit together and contact with the customers, and I feel it is stick.
I just have a point here.
Yes.
Is it also related to the, because during COVID and post-COVID, now the income levels are now inching up. Is it giving a disposable income which is a little higher, which can now have an allocation towards gold?
So that is something that we will examine with the new survey that is being conducted. Whether with increasing in, COVID was a major shock to the economy, right? GDP went down by about 7%. So now that GDP is now starting to go up, per capita GDP is starting to go up, whether households will move away from gold or will they actually continue investing in gold?
As he's saying, the households, the average billing has actually gone up by 60%. So my question was because post-COVID now, if the income level has gone up, it is giving them more disposable income, and then they are investing because they have tested or tasted, that period, and they are now getting into that. Okay, we should have more gold at their disposal. That's
exactly.
Yep.
So there are 2 aspects to it. One is the demand for physical gold. The other is demand for digital gold. So what typically happens is that because of the crisis, many people actually got the taste of digital gold, buying this gold in small quantities. And that is a trend that is sort of persisting even after the crisis. So we'll be able to examine it much more closely with the coming survey.
When they do, partly also to kind of supplement the conversation, for Thangamel, there is a certain phenomenon that you have seen in your shops or in the areas that you operate in Tamil Nadu, right? Whereas this particular database is on the basis of 119. Your 4,000 was for 119 districts across the country, and for 19 states. So across the country. So maybe from what you are saying in Tamil Nadu, it would appear that the purchase of gold has actually even gone up beyond the flight of safety. It's even more than what it used to be. So the interesting question would be that, is that true also for the rest of the country? So that's hopefully what we will be able to discover. Yeah.
Thank you.
During the COVID crisis, you have seen the people were struggling for living and eat basic needs. Your case says that the gold has gone up. Do you have granular data on which are the households and who have purchased this gold? Because flight to safety is okay for the middle class or upper class who go for the assets, like there is turmoil in equity and also they can shift to the gold. But what about the class which we call lower middle class or below middle class? Whether do you have this granular data and what were your observations on that?
So on the average, this is something which might actually give some idea. So gold actually went up. So we were looking at the relative allocation, right? When you look at the absolute changes, what you see is gold went up by 3,600 rupees. Financial assets went down by 13,000 rupees, and other assets went down by 4,000 rupees. So when you look at the share of gold is increasing, both in absolute terms and relative terms, but you see a massive drawdown of financial assets and other assets. So people are not, so initially we thought that there'll be a drawdown of all types of assets, but maybe a lesser drawdown of gold. What we see is that gold is actually increasing, but other assets are actually going down significantly. But it's actually worth examining it by income quintiles. So we looked at rural and urban areas, we didn't find much of a difference. So we'll look at it in terms of income quintiles as well. Just make a note. Okay, thank you so much.
I have one clarification.
Huh?
Yeah. You have taken three categories of assets: gold, financial asset, and other assets. In other assets, you have clubbed cash with physical metals as well as real estate. So won't it be, what is the consideration? Like cash is something and the consideration for investing in physical metal or real estate is something else. So would have been better, it would have been better possibly if you bifurcate cash and other physical assets. Would the results change? What is your opinion?
So here, if you look at other assets, about 60% of other assets is cash. So it's dominated by other assets. Investment in real estate is relatively small, it's quite small, and investment in other precious metals is also very small. So, and the reason we combined it, I mean, we have the disaggregated regressions also. They tell a very similar kind of story. So when we look at the disaggregated, but the thing is that when we look at cash versus the immovable assets, we find that the drawdown is typically in terms of cash and not in terms of, so much in terms of real estate and other fixed assets. Thank you, sir. Yes.
Sir, do you have you taken into account whether this purchase, the rise in the purchase of gold, whether it was in physical form or digital form?
So most of it is physical gold. So digital gold is actually very, very small. Okay. So it might have increased in the post-COVID period.
How much will be the contribution of this digital gold during the, you are taking it for the 2020?
Exactly.
So in 2020, there was a huge increase in equities and trading volumes because people were sitting in the home and all. So whether there was a significant increase in gold, digital gold or something, ETFs, gold ETFs?
So digital gold did increase quite a lot, but from a very, very low base. So the base was was extremely small. Minal knows about the distribution in terms of digital versus physical gold. But digital gold is it increased a lot, but from a very, very small base. So it's mostly, I mean, most of the gold is actually physical gold jewelry and bars and coins. Thank you.